Hi everyone, my name is Piterpakulski. Today we have a final overview of a street food chain financial model. I will walk you through the whole business model that we've created. I'll be giving all the links on the creation of this financial model at the description of this video, so you can look how this financial model was created from scratch. And today I will be just going from top to the bottom, showing you what inputs affect the financial efficiency: simple, discounted payback period, internal rate of return, and other the amount of financing that you need, and other financial parameters. So maybe you will find this video valuable. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. And let's start. So the first rule is that all our inputs are colored with blue. So this is the specific color which goes with all our inputs. So here we have all the inputs that affect the revenues, expenses, and then they transform into the cash flow statement, showing us the main financial efficiency parameters. So how the model is organized. So the first step is the model itself, with the revenues, expenses, algorithms, model spreadsheet. We have cash flow statement. Then we have main tables that consisting of the types of financing needed for the business idea. Then we have two main diagrams: simple and discounted payback period of our business idea. Here we have here we specify the discount rate for our chain, the step of changing discount rate to calculate more accurately the internal rate of return of our business idea. And finally, for stress testing, we have a sensitivity analysis block. I'll be showing where we have consolidated all the financial efficiency parameters. And then we're going to push this button and test how the business performs if we increase the revenues, decrease the revenues, increase expenses, decrease expenses. This is a very interesting instrument that I'll be showing you in this video as well. So let's go up. So first of all, we have so we are talking about street food chain. This means that we have different types of spots in our chain, and we can name these types of spots, and here we can switch on and off each type of spot from calculations to make us see the performance of business idea with or without this type of spot inside the cash flow. So we can just simply switch it off. For example, we can go back to the simple and discounted payback period diagram. Let's see what will happen to the business if we, for example, this portrait of street food spot is too optimistic for us, and we would like to see what will happen if we don't have this type of street food spot in our calculations. Then we should specify the average check. So each type of street food spot is different. It may differ by average check. It may differ by the amount of checks, because, for example, some locations can be near business centers, for example, or inside business center, and we won't have revenues during the weekend, for example, like here. And for example, some spots may be, for example, located in the airport, where the revenue doesn't have any seasonality, and it works 24 hours, 7 days a week, 365 days in a year. So, and it has no seasonality. And we can describe our business idea from perspective of different average checks and the amount of checks inside a typical week. So first of all, we are describing what is the average check for each street food spot. Then we have the block for coefficients. So the block of coefficients will appear near the majority of inputs, because we can play with this will allow us to play with scenarios very quickly. So for example, we don't want to switch off street food spot type 6 from calculations. We just want to decrease the average check on 50%. So we just take 50% with basic value, and we can go back to the diagram and see what will happen with our project. Also, we can go here and see how this change will affect the general financial efficiency parameters. And we can play with these coefficients without playing with inputs themselves. So this gives us an opportunity to create a huge amount of scenarios, quickly play with data, look at the cash flow statement, look at the financial efficiency. So then we specify the level of direct expenses inside the average check. We also have coefficients for direct expenses. So this is global coefficient, increases the level of direct expenses to the whole bunch of types. For example, if we want generally increase the level of direct expenses inside average check on 30%, we can do it like this. We can go back to the simple and discounted payment period, or for example, we don't want to increase the expenses for all types, but we can, for example, we just want to double the expenses of street food spot type number 6 and see what will happen. We can go back and see what will happen. So this is very important for scenario play, because when the financial modeling will be over, when you build when you build the model itself, you will start playing with, you will look at the cash flow statement, and at this moment you will want to play with different coefficients. What will happen if this type of expense rise, or what will happen if this revenue of this type of spot will decrease, on what percentage, and how this will affect the financial efficiency. So you will be asking tons of questions. Then we also have a dynamic time parameter of life cycle for each type of street food spot. So for example, our legend is that some types of spots may generate losses, and we won't keep them. So if they, for example, generate losses, we keep them. So this type of, for example, type number 5, street food spot number 5 generates losses, and we create the portrait for the street food spot generating losses, and we say that after 24 months of operating activity, this type of spot will be closed. And this is very interesting to look at the project itself, how many spots with losses you can afford, how they affect the financial efficiency. So this is also a very interesting exercise when you are done with all the financial modeling processes. So then we are moving to the amount of checks. So we are describing the portrait of each type of street food spot. So we are taking the typical week of its work, of this operating activity from Monday to Saturday. Here we also have coefficients for the amount of checks. So we have coefficients for average checks, and we have the coefficients local and global for the amount of checks. So we have coefficients for both components of the revenues. So this is also very important. Then we describe the seasonality of revenues inside the typical year. So first of all, we describe the typical week. Then we're describing the revenue of this or that street food spot inside the typical year, and we say that this amount of checks is 100%. And for example, in April, May, June, July, August, so we have some decrease in amount of checks in revenues, and this will also affect the cash flow statement later. So this is the block where we describe the seasonality of our business idea. Then we move to a very important part of our business idea. So we have a chronological table where on the left we specify we have different types of street food spots. So these are the types of spots. And here we specify when we are going to open this or that amount of spots. So here we are moving inside the chronology, and we just specify, so here we have the diagram like this, but for example in April 23 I just want to open five street food spots type number 6. I can go here, see how the diagram changes. So for example, also I would like to open 3 spots of type number 4. And we can see how the diagram jumps up and down. And here is the very simple table where you can play with how you're going to develop your chain, and here you can see how jumps or decreases the amount of financing you need to start this scenario, and you're just playing around with these inputs and looking also at the amount of money that you need to start the business in this or that case, in this or that scenario. So this is a very interesting story. Also here you can we have coefficients for the amount of spots, local coefficients and global coefficients. So for example, if you want to increase the amount of spots in general, you can use these coefficients global. If you want to increase or decrease some specific type of spot, amount of spots in our chain, we can use this local coefficient. Then we are moving to the next very important block of inputs. So we've created the algorithms for seasonality, for the amounts of checks, for behavior of customers inside the typical week. But when we open this or that type of spot, we won't be able to get the maximum of revenues right from the first month of operating activity. So we will be reaching it step by step. And here we have, let's say, the first 12 months of operating activity from the start. This 13th month will be extrapolated over the chronology. And here we describe how fast we achieve our planned amount of checks that we've created before, the algorithm that we described before. So for the street food spot number 1, we say that we just get on the first month of operating activity, we will just get 10% of revenues, then 20, 30, 40, and so on. For example, street food spot number 4, it is placed, for example, in the airport, and we get 100% of revenues right from the first month. So here we describe how we reach the planned revenue parameters. So this is very important. Why? Because this will affect the operating losses. So if we don't get the maximum revenues right from the first month, this means that we may face some operating losses, and these operating losses will be added to investment activity, and this will affect the total financing you will need to start the business. So the total financing will be investment stage expenses plus operating losses, and these operating losses may occur here because we get only 10% of revenues. And if we go, let me just jump to the cash flow statement. So we can see, for example, this number. So we do have the revenues, but we have losses. So our expenses during the first month of operating activity are bigger than our revenues, and we get the operating losses. And we have to add these losses to these investments into the chain to get the total financing needed to develop to start this business. So counting operating losses is available only if we create this algorithm, and we can start playing with reaching the planned revenue. And this will show us a very interesting thing. It will show us the gap between pessimistic scenario, optimistic scenario in metrics of financing needed. So in optimistic scenario, when we will get the planned revenues faster, the amount of financing will be needed less. In other cases, it will grow, and you can play with these numbers to see what is the minimum financing you need, what is the maximum financing that you need. So if you have operating losses not for a period of 1 month or 3 months, for example, if you have operating losses during 6-8 month period, so this will give you a lot of interesting information about your business idea. 100% promise you. Then we start we start describing the salaries of the people who work in our chain. So this is the list of positions. This is the salary monthly paid to this one person on each position. We can switch on and off this position from calculations. We can also add coefficients. We can play with coefficients. Here we have the table. So here we have the list of street food types. So this is the amount of people on each position with seasonality for each type of street food type. So for street food type, the amount of people on each position inside the typical year we will place here. For street food spot type 2, we will have this amount of people with seasonality on each position. And here we describe the amount of people on each position for each type of street food type. Then we describing fixed expenses. So this is the street food spot type 1. Here is the list of fixed expenses with their seasonality. So we are taking the typical year and describing different types of fixed costs for just one street food spot type 1. And here we do the same for street food spot type 2, 3, 4, 5 and 6. So here we describe fixed costs. Then we have coefficients, local and global coefficients for fixed expenses. Then we are moving to investment plans for each type of street food spot. So here is the beginning of operating activity, and before this operating activity starts, we have 3 months of an investment period, and here we specify what we invest in, and here we specify when we invest in and how much we invest in just one street food spot type. And now and here it is done for each type of street food spot type. Now we are moving, so we also have coefficients local and global as well, so we could easily play with the investment needed for the business. Then we have direct expenses that are linked, that are closely connected to the amount of spots in our chain at any given moment. And here we specify these type of direct costs. Here we specify what is the monthly cost for this direct cost item per spot. So this is the value dollar per month per spot. We can switch these costs on and off. Here we have local and global coefficients. Then we have the story about management company. So as soon as our chain grows, for example, up to 10, 20, we can specify the amount of spots. Here we will introduce a management company. So management company, so here we specify when we introduce the management company. So for example, we can change this value to 10 or 15 spots. So this is the amount of spots inside the chain. So when we reach this amount of spots, we start a management company. Then we have fixed costs for management company. So this is the value per month of these fixed cost expenses coefficients. Then we have payroll of management company. We have investment plan for management company. And then we have the block for loan. Here we can specify the amount of loan, the term of loan, interest rate for the loan, grace period for principal payments, for interest payments. Here we specify when we get this loan, in which year and which month. Then we specify the rates of taxes. And here we finally get the cash flow statement. So here we are able to see what is the monthly profit of our business idea without loan. Here we can see the amount of financing needed for the business. Here we can see at cash balance at the end of the period. When the project it's our cash, and then when the project starts generating its own cash. So here we can look at the cash flow statement and see how the breadth of your business idea. Usually when entrepreneurs see this cash flow statement, they start playing with inputs, with coefficients, they start scenario playing, so this gives them a huge portion of food for rethinking their business concept. So this is a very big part of business analysis. Then when we look at the cash flow statement, the next block of inputs is specifying the discount rate for your business idea, for your chain. Then we specify the step of discount rate changing to calculate accurately the internal rate of return for your business idea. And then we are moving to stress testing. So for example, we have the basic values of financial efficiency, and we would like to see what will happen to the business. For example, if so we can go back here. If the amount of checks for street food spot type 6 will increase or decrease. So we can go here, we can press equals and multiply this parameter on this cell, then press enter. So now this coefficient has been added to our model, and we can just delete this area. So we are going to look at the financial efficiency with the step of change the parameter of 10%. So 100% is the basic value of financial efficiency, and then we see what will happen if the amount of checks will rise on 20%, 10%, 20, 30, 40%, and here will be the financial efficiency if the amount of checks will be 90% of base value, 80%, 17, 60. We can also, for example, change the step and see what will be the change of financial efficiency if we more dramatically increase the step of changing. So let's do it, for example, and press the sense button, and I will show you how it works. So here we can see what will happen with the project if the amount of checks will rise or decrease. Also, we can add this parameter, so we can delete this parameter from expenses, from amount of checks, and add this parameter to the direct expenses, for example. So direct expenses, and we can look at the general coefficient. We can add this parameter to the general to the global coefficient of direct expenses in every check. So here we are adding, then I press enter, then I press sense, and here we see another story, what will happen with financial efficiency if the direct expenses in every check will grow or decrease. And usually entrepreneurs they want to add this coefficient to a huge list of parameters. So when they are done with financial model, they start playing with coefficients, these coefficients, without playing with their basic values, and they see what will happen to financial efficiency if this happens, that happens. That's why I decided to show you all these instruments, so maybe you will start looking at your business idea a different way. I will give all the links to the creation of this financial model from scratch at the description of this video. You may give us a like if this video is valuable for you. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So see you guys in next videos. Thank you.